Fundsupermart.com.
Hi Amy, what is your outlook for the Singapore equity market over the next 2 to 3 years?
Right. If you look at Singapore and the government's emphasis on good quality growth, we think that the long-term economic growth for Singapore would be lower from about 2 to 3% against a past decade of about 5%, 5 to 6% growth. So against this backdrop and considering that the market has done very well and we believe trading at fair valuations, we think that any upside for the market from a top-down perspective will be quite moderate. Nevertheless, the focus is really on a bottom-up basis, which is stock picking, and that is really the heart of Manulife's process. And we think that if you look at companies from a bottom-up, there are several companies who have, against this backdrop of slower long-term growth, these companies have niche strategies, very focused strategies, and we think that with their focus, they can grow better than the long-term GDP growth numbers. And then there are companies who also have very good and undervalued assets, and also companies who generate very strong cash flows and pay out healthy dividends. So from a bottom-up basis, we think there are still stock opportunities to be had.
Are there any sectors within the Singapore equity market that you are currently more positive or negative on?
One of the sectors that we think will be emerging in the medium term is the consumer sector, and the reason being that we know that the labour market is tight and wages remain healthy. I think this bodes well for domestic consumption, and over the years we've seen, in the last 2 years especially, we have seen some of these being IPO'd, such as Courts, Sheng Siong Supermarket, in addition to more established ones such as Osim and Dairy Farm. Of course, the biggest well-known one is F&N, but that is likely to be delisted with a pending takeover. But what is interesting is that there are actually a lot more companies we think would be listed, although they are still in the small and medium cap space.
Asian bonds have delivered steady returns over the last year. On the back of such positive performance, what is the outlook for SGD-denominated fixed income securities?
I think if you look at monetary policy, we think that central banks will still continue to be fairly accommodative as the long-term challenges in the global economy is still there. But nevertheless, so we are seeing quite a bit of abundant liquidity, and therefore we do expect government yields to be fairly low. However, with many corporates having strong balance sheets, we think that picking on investing in corporates is still a viable strategy to pick up yield and enhance return. On the other hand, this, as you said, has been a very well-performing asset class, so we cannot rule out volatility even in this year. And if risk sentiment continues to improve, then we might see a sell-off of this asset class to fund into riskier assets such as equities.
Amid the current low interest rate environment, how does investing in SGD-denominated bonds contribute to meaningful returns?
As I've mentioned, one of the ways is really to look at corporate bond yields with companies having very strong balance sheet and not overly geared. The debt, the corporate bonds of some of these corporates actually look interesting still, and you get a pickup above the government bond yield. On the other hand, if the volatile environment does pan out, as I've said, investors sell out of this asset class in the immediate term to fund riskier assets, then it could present some opportunities for duration and interest rate positioning, bearing in mind that we think that the medium to long-term outlook for interest rates still remains very benign.